In this video, we're going to be taking an in-depth look at Enbridge. They are a North American oil and gas behemoth, and the goal of this video is to determine if this company has the characteristics of a good passive income investment. So what we're going to do in this video is define certain characteristics that stocks can have that would make them good passive income investments, and then apply those to Enbridge to see if they meet that criteria and how well they meet that criteria. Now, if you guys have been watching my channel for a while, you know that I like to conclude my videos by doing valuations of these businesses, but in the case of Enbridge, I'm not going to do that. We're just going to talk about the passive income side of this company. And that's just because the valuation of this company does have a lot of nuances to it. It is pretty difficult to do just due to the nature of the business they're in, and that's something we're going to talk about later. This is a channel that is dedicated to helping retail investors understand business fundamentals. We take a very structured approach when we look at companies. We look at quantitative aspects, qualitative aspects. So if you think this is content you'd be interested in, I'd greatly appreciate it if you would consider subscribing to the channel. My goal is to get the channel to 1,000 subscribers by the end of the year, so if you could help me reach that goal, I would greatly appreciate it. But without further ado, let's actually jump into the company now and look to determine if Enbridge is indeed a good passive income investment. Okay, so what features would make a stock a good passive income investment? Well, there's quite many, but we're just going to focus on a few key ones in this video. So as of recording this video, Enbridge is currently paying around a 6.5% dividend yield. Now this is quite high. This is much higher than what you typically see as the average for total world stock market index funds, which is usually in the range of 2–2.5% dividend yield. But as prudent investors, we know that just because a company is paying a dividend does not necessarily mean that it's safe. It's really not uncommon to see companies pay very high dividends just to lure investors into buying their stock for that purpose. So the last thing you want to do is buy a company just for the dividend only to see it get slashed later. So that's what we're going to look to determine here. Now, one thing that makes a company's dividend safe is if they have a history of strong and stable free cash flow. And notice I said free cash flow and not earnings. Now, if you guys have been watching my channel for a while, you know that I'm a huge advocate of looking at free cash flow as opposed to just looking at earnings, because earnings are really just an accounting calculation. There's so many different things that can impact earnings that don't necessarily impact free cash flow, which is really how you get paid back as an investor. For example, they could have some equity investments they make, and if those equity investments increase in value, that gets recorded as earnings. But it's not actually cash flow because they don't get the cash until they sell those investments. Another one would be something like an impairment charge, which is pretty common for companies like Enbridge because they have a lot of assets. So if an asset loses a lot of value, they have to record impairment, and that decreases their earnings, but it doesn't decrease their cash flow because it's not a cash expense they're paying. It's just an accounting calculation. So that's why I personally like to look at free cash flow as opposed to earnings. So for the most part, Enbridge is a fairly predictable business. Now, they've been around for a while, so we have many years of historical financial statements that we can rely on, which can help us determine if cash flow is indeed stable. But being in the oil and gas industry, they are subject to fluctuations in the prices of oil and gas. Now, that doesn't necessarily impact them directly because they have a lot of long-term contracts set up with their customers. However, it does influence other parts of the supply chain because they are a midstream company, which can in turn influence their revenue. So we saw this happen last year. The revenue was down quite a lot. So let's actually take a look at some historical financial information and see how Enbridge has kind of played out in the last 7 years. Okay, so what you're looking at here is 7 years of historical financial data for Enbridge. So we'll start at the top line with revenue, and we can see if we look at it over 7 years, it basically hasn't grown, except for the fact that it grew pretty much every year, except for this huge drop-off that we had from 2019 into 2020. So that was kind of what I was talking about. I mean, a 22% decline is pretty significant. Now, if we go down, we can see net income went from 5.3 billion to 2.9 billion. Now, despite that, cash flow from operations actually increased. So despite the fact that their revenue went down 20%, their net income went down about 44%, their cash flow from operations actually increased, and their CAPEX was basically the same. So if we're looking at their free cash flow, if we just define it simply as cash flow from operations minus capital expenditures, I mean, it was pretty stable year over year. Now, this is the exact type of thing that you want to see in passive income investments. It's the ability to withstand very strong headwinds in the industry, such as what we saw last year with the significant decrease in oil demand leading to lower oil prices. Now, if we want to understand why this actually happened here, so we go over here to their annual report of 2020, and this is their statement of earnings. So we can see their revenue here. This is their income statement. So 39 billion in 2020, 50 billion here. and then we look at their operating expenses. So one of the bigger reasons why their cash flow is able to remain the same is just because of the way their contracts are set up. Their operating expenses were about $10 billion less in 2020 than 2019. If we look, about 42 billion here and then 31 billion here. The biggest reason for that is the commodity costs. So that's the way they have their contracts set up. Commodity costs pretty much made for the entire decrease in operating expenses. So based on that information, you'd think, okay, well, net income shouldn't have gone down 44%, which it did. It should have pretty much stayed the same. And the reason it went down so much is this impairment of equity investments charge here, about 2.3 billion. Now, this is the exact type of thing I was talking about before, which is why I look at free cash flow and not earnings, because free cash flow won't have this impairment charge here, but earnings will. So earnings are going to look like they absolutely took a nosedive going from 2019 into 2020. But the main reason is because of this impairment charge here, which it impacts the business, no doubt. I mean, it's definitely not something that you want to see, but it doesn't impact their cash flow. It's not really going to impact how you get paid back as an investor in this business, except for the fact that these equity investments that they now hold are worth less. So if we scroll down, we could go to their cash flow statement. So this statement here, and then here if we look at this part here, we can see the fact that their cash flows were quite stagnant. And then we can see right here, there's that getting added back, that impairment charge getting added back, because that's just how the accounting for it works. It impacts earnings, but it doesn't impact cash flow. Okay, so all that stuff is great, but what we want to do is actually compare the amount of annual free cash flow they're generating to the amount of cash dividends that they're paying, in order to make sure that this dividend that they're paying, which is quite high, is in fact safe and they can actually afford it. So it's not unprecedented for companies to pay dividends that are quite high in relation to the free cash flow they're generating, and the reason they do that is just to entice investors into buying their common stock. So if they're paying a dividend that they can't necessarily afford, meaning their free cash flow can't cover it, they're going to have to raise financing in some other way in order to continue to pay it, which they can do by either raising debt or raising equity, which raising equity to pay a dividend really is not something companies should be doing, because if you think about it, it's basically like a Ponzi scheme, because really what they're doing is taking money from new investors and then using that money to give to old investors in the form of dividends. So you generally want to avoid companies that are doing that. But I digress. So what I have here in this dividend coverage part, you see I have two definitions of free cash flow. So one is just basic free cash flow as it's most commonly defined, cash flow from operations minus your capital expenditures. Now I divide that number by the cash dividends paid. Now if you're wondering where I get the cash dividends paid number, it's quite simple. You just go back here to their cash flow statement, and then you go to the financing activities section, and you scroll down and you usually see a section here, common share dividends right there. And we can see how it's grown the past few years. So it was about 6.6 billion, about just under 6 billion in 2019, and then 3.5 billion in 2018. So a pretty significant jump going 2018 into 2019, and then another jump into 2020. Now they also have preferred shares, which is something we have to take into consideration. And if we look at common shares issued, it's basically nothing. So nothing really to worry about there. Now you're probably wondering, why do I have two definitions of free cash flow? I mean, and what is free cash flow to equity? Now keep in mind, neither of these metrics are metrics that companies themselves report. Now you'll often hear free cash flow defined as just cash flow from operations minus capital expenditures. And this isn't wrong, but it's a very simplified version of what free cash flow really is. And on this channel, we like to look at free cash flow to equity, which is more representative of what you receive as an equity holder, because companies like Enbridge, as we know, they have some debt, and the debt holders get paid back before the equity investors do, and they have priority over the equity holders, as do the preferred shareholders. And if they have debt payments that are due, that's cash that's going to the debt holders and not going to the equity holders. So if you define free cash flow just simply as cash flow from operations minus capital expenditures, it doesn't capture those debt payments or those preferred share payments that you have to take into consideration if you're looking at investing in the common shares of the company, because both those classes have preference over the common shareholders. So free cash flow to equity is cash flow from operations minus your capital expenditures minus your debt repayments plus debt issuances minus your preferred share payments, which would be preferred share dividends, which we saw they have, plus the proceeds you receive from issuing preferred shares as well. Now you're probably wondering, why is debt being added back? Well, it's because if a company takes on debt, that's money that they now have that they can use to pay dividends, buy back shares, make acquisitions, whatever they want. They don't always do that, of course, but it is an option that's available to them. So because of that, it gets added into the equation. But of course, that debt has to be paid back someday, which is why debt repayments are subtracted when you're also calculating free cash flow to equity. And then the exact same thing applies for preferred share dividends and issuances of preferred shares. It's the exact same concept there, because both of them have priority over equity holders. So I know it's a confusing concept to wrap your head around. I felt the same way when I learned it at first. And so if we look here at free cash flow to equity, we can see it's pretty much been positive except for this 1 year, and in the past 2 years, it's been quite high. Now this takes into account debt repayments, like I just explained. So if we go up here, what we have bolded here is free cash flow to equity, and we can see their cash flow from operations, their capital expenditures. So if we look at 2014, for example, only $2.5 billion in cash flow from operations, and then $10.5 billion in capital expenditures. So where's the money coming from to make those capital expenditures? Quite simply, they're just taking on debt in order to make them. And they've been taking on additional debt every year, except for a few years. 2016, they paid some down. 2018, they paid some down. But overall, their debt is going up. And then there's some action with preferred shares. There's the preferred share dividends here. So overall, free cash flow to equity, it has been growing, and it's been quite strong the past 2 years. So that's definitely a good sign to see. Now, how does this tie into dividend coverage? Well, let's look at free cash flow as just cash flow from operations minus capital expenditures, so not taking into account the debt. Well, we can see here, if we look at the percentage paid out, they've pretty much never been able to afford their dividend if we look at it on this basis. Pretty much every year, they either had negative free cash flow or their free cash flow was less than the amount of cash dividends they paid. If it's above 100%, that means the dividends they paid exceeded their free cash flow. But if we look at it on a free cash flow to equity basis, it's a bit better, but pretty much the exact same concept. In these earlier years, they were paying an amount that was more affordable, but overall, they're paying more in dividends than they're actually bringing into the business. Now, there may be some utility investors or oil and gas company investors out there who are seeing me look at dividend coverage in this way, and they're spitting out their coffee saying, this is blasphemous, this is wrong, because what I should be looking at is something called distributable cash flow. Now, distributable cash flow, it's another non-GAAP metric, which means companies don't have to actually follow any rules when they calculate it. They can calculate it in their own way, and it's usually what people will look at when determining whether or not a dividend for a company like Enbridge is actually sustainable. Okay, so what actually is distributable cash flow, and how is it calculated? So like I said before, it's a non-GAAP metric, so the management does have a bit of leeway in deciding how they calculate it, but if we go to literally the last page of this company's annual report, it actually details it. So it says distributable cash flow is defined as cash flow provided by operating activities before changes in operating assets and liabilities, less distributions to non-controlling interest and redeemable non-controlling interests, preference share dividends, which we talked about, and maintenance capital expenditures, and further adjusted for unusual or non-recurring or non-operating factors. Okay, so that definition is obviously extremely confusing. There's a lot going on there. There's a lot of technical terms. So I'm going to break down 2 of the technical terms included in there a bit more. So one of them is maintenance capital expenditures. So what are those? Well, capital expenditures can be broken down into 2 types. There's maintenance capital expenditures and growth capital expenditures. Now, maintenance capital expenditures is basically just the company's depreciation charge, because that's basically what they needed to pay in capital expenditures to refurbish their assets and bring them back to the state that they were in order to maintain their existing operations. Now, growth capital expenditures are new capital expenditures that they're making to grow the business. So an example of that for Enbridge would be making capital expenditures in the renewable energy space. We know that that's something that they're going to have to expand into the future, because renewable energy is becoming more prominent. Also, if they want to achieve net zero, they're going to have to move more towards renewable energy. So that would be a growth capital expenditure. But then say they have, one of their midstream assets that, it's getting depreciated every year. They need to make some capital expenditures just to maintain it. That would be maintenance capital expenditures. Now, the other part of that I want to explain was the very last part, where they talk about how they adjust for non-recurring or extraordinary items. Now, you got to be careful when companies say that they do this, especially for non-GAAP metrics, because they have the ability to choose what they want to consider as non-recurring. And oftentimes you'll see companies say that this expense is non-recurring, except it's occurring every year, so it's not exactly non-recurring. You usually see companies that are buying a lot of other companies do this, where they have their acquisition costs and they say, well, these costs are non-recurring, but they're happening every year. Same thing with share-based compensation. A lot of companies will have share-based compensation and they add this back, kind of saying it's a non-recurring expense, or usually when you're looking at EBITDA, they'll add it back to adjusted EBITDA, but it's a necessary expense. I mean, they can't get out of paying it. They're paying it for a reason, right? So it's always good to make sure that you pay attention to those things. So why I don't like the distributable cash flow metric is because it excludes growth capital expenditures. Now, ultimately, when a company pays a dividend, they pay a dividend using cash that is sitting in their bank account. Now, when they pay for capital expenditures as well, they also need cash sitting in their bank account in order to make those payments. Whether or not you want to call it maintenance capital expenditure, growth capital expenditures, whatever, you need the cash in the bank account in order to pay it. So that's two ways cash is leaving the bank account. Now, the way cash is coming into the bank account is by cash flow from operations, so just doing their regular operations, the oil and gas space, or by issuing debt or issuing equity. Now, as we saw historically, their cash flow from operations has been growing, so that's allowing them to continue to pay higher and higher dividends, but they've also been taking on more debt because their dividend payments are quite high, and they do have to continue to reinvest back into the business, the maintenance capital expenditure part, and make growth capital expenditures to expand the business, like we talked about earlier with moving into renewable energy. Now, that's really what makes a company like Enbridge so tough to value, because if we were to do a discounted cash flow valuation for Enbridge, we would pretty much conclude that they're just ridiculously overvalued, because usually how you do that is you look at what their free cash flow has been historically and then try and project it going forward. And unless you assume it's just going to explode going forward, you would conclude that they're very overvalued because their free cash flow is so low because of these capital expenditures they're making. But obviously, as we've seen, they continue to pay dividends, they continue to raise their dividend. So then the question becomes, is that sustainable? Now, it's a good thing to see that their cash flow from operations is growing, which is offering some support to that, but they do also need to continually reinvest into new growth capital expenditures to grow their business, because they have to achieve net zero, right? That's part of the whole ESG thing that we're seeing happening in investing now. So that's a really big part of it. Now, one thing to understand is when they make those growth capital expenditure purchases, they can actually finance those with debt, because they are usually long-term assets, and what companies will do is pair the financing for an asset purchase with however long they plan on using the asset. So if it's, say, a renewable energy asset that they plan on using for 20 years, they'll get a 20-year term loan and attached to that. So they're not using so much of their own cash that's sitting in their bank account in order to make those payments, but they're just taking on new debt, and that debt is secured by the asset itself. So that's one of the reasons why seeing their debt levels go up, kind of like we saw, isn't something that should be super alarming. It's really expected for these types of businesses. You see something similar with a company like Algonquin, which is a company we looked at previously on this channel. You pretty much saw the exact same thing. Okay, so another attribute that you want to see when you're looking for a good passive income investment is you want to see the company have low debt levels. And the reason for that is because pretty much what we just talked about, if the company has high debt, it's obviously required that they pay that debt back, so that detracts from money that they could use to pay dividends to common shareholders, because instead the money's going to the debt holders. So let's take a look at their balance sheet and see if we can gain some information about what type of debt this company has. Okay, so here we're looking at the balance sheet for Enbridge. So let's start just by looking at the assets. So total assets here is about 160 billion, which is quite a lot, and as expected, most of that is going to be in property, plant, and equipment. So that they have about $94.5 billion in there. Now, if we move down, we can look at liabilities and equity section, and let's look at long-term debt. So this is long-term debt here, about 63 billion. Now, it was just under 60 billion in the prior year, but there's also the current portion of long-term debt. So that's called current liability because it's the portion of long-term debt that is due within the next year as of the date of this filing here. So that number did go down year over year. So their debt levels really they have gone up, but they haven't changed drastically. But as we saw previously, they are continuing to increase their debt pretty much every year. Now, if we look at it using the debt to equity ratio, this is a ratio that a lot of people like to use. It just helps you compare kind of how risky a company is by how much debt it has. So we can see the total liabilities, which is what you would call debt when you're looking at the debt to equity ratio. You look at total liabilities, not just long-term debt.
So about 96 billion. And then total equity is here, it's about 64 billion. So that's about a 1.5, 1.4 debt to equity ratio. Now pretty much anything above 1 would be considered high, but for a company like Enbridge, they do have so many long-term assets, like property, plant, and equipment, as we saw. So having a debt to equity ratio that is a bit higher than that isn't really something to be alarmed about. Okay, so overall with the debt, while it is increasing, it's not necessarily at an alarmingly high level, so nothing really to be too worried about there. Okay, now one last thing that is a good thing to look at when you're looking for a good passive income stock is the fact that is the industry they're operating in a necessity, and is the company a prominent player in that industry? Now, the oil and gas industry is definitely a necessity. Now, you may sit there and say, Eric, in the future, there's going to be some point where the world is powered by renewables and not oil and gas. And while that is true, there is still value in a business as it stands today. Even if that business is in decline, even if Enbridge has basically no growth going into the future, there's still value in their business. And they are such a prominent player in the industry. I mean, they have a very large established network of assets. It's really hard for companies to come in and compete with Enbridge. So they do have what you would call an economic moat, and it is probably safe to invest in them for the long term. Okay, so final thoughts on Enbridge. So overall, I do like them. I do think they are kind of a safe investment. You can expect pretty low volatility in a company like this, and you will likely continue to see fairly stable dividends with probably minimal capital appreciation going into the long term. Now, I wouldn't expect their dividend to get raised too much from here on out, just because they are in an industry that is in decline overall, and they are going to have to use a lot of their cash to make capital expenditures like we talked about in the renewable energy space, because they're pretty much forced to do that now with the rise of ESG investing and how people care more about companies that are acting sustainably. They don't really want to invest in companies that are seen as, bad for the environment. That's just the way it is nowadays. Now, the rising debt levels is a little bit of a concern, so it's something to keep your eye on going forward. I would like to see a bit more debt repayments from them going into the future just to reduce those levels a bit. And ideally, you want to see them be able to afford their current levels of dividends with their free cash flow and not have to take out additional debt. So that's something that I personally am going to look for going into the future with this company. But anyways, guys, that pretty much does it for me. So thank you so much for listening. I hope you did find this video useful. If you did, then please leave it a like and subscribe if you're new to the channel. And I'll see you in the next video.